This is a companion video to the one that I published yesterday titled Short-Term Interest Rates. I discussed there that I would start shifting income into 2025 by buying more treasury bills that mature next year. I'm going to explain in this video in more detail my reasons for that approach. Interest income is taxed in the year that the treasury bill matures when held to maturity. I'm currently extremely overweighted in short-term fixed coupon securities consisting of treasury bills, CDs, and corporate bonds maturing within 2 years, and in a money market fund, primarily in my Vanguard brokerage account, where I receive the highest yield among all the brokers that I use. If the Fed starts to cut the federal funds rate this year and continues through 2025, as currently expected, the yields on those securities and the money market funds will decline in tandem, resulting in lower interest income from the available reinvestment options when those securities mature. That will result in 2024 being my peak year in interest income, with a significant decline in 2025 and a greater decline in 2026, assuming the current forecast of Fed rate cuts proves to be close to what actually happens, and I do nothing to change that result now. Those forecasts are subject to change based on the future developments and are based on trades in the federal funds futures contracts. The CME FedWatch tool, which uses those futures contracts, currently forecasts that on or before the Fed's September 2025 meeting, there is an 81.5% probability that the federal funds rate will be 4% to 4.25% or lower. The better than 50% probability is at 3.75% to 4%. The current range is 5.25 to 5.5%. The 1-month to 6-month Treasury bill yields currently reside in that FF range, as does the Vanguard money fund that I use. All of those yields will go down in tandem with cuts in the federal funds rate. The market is forecasting that the dominant trend will be for inflation to decline sufficiently to justify the Fed rate cuts that are currently reflected in the federal funds futures contracts. A major reason for that forecast is the fictional expense called owner's equivalent rent, which the Bureau of Labor Statistics, BLS, weights at almost 26% in CPI and less in core CPI. And that fictional expense assumes that homeowners pay themselves rent in order to live in their homes that they own. This fictional expense has been a major contributor to both CPI and core CPI inflation and will start to decline year over year to reflect current reality after a considerable lag period in measuring that fictional expense. The government does not actually use home prices to measure owner's equivalent rent, but rents paid by apartment dwellers. Zillow estimates that the average rent was $2,164 nationwide in May of 2023, $2,164. But it followed to $2,000 in December and $2,012 by March of 2024. So the numbers are actually declining year over year, but the Bureau of Labor Statistics claims that owner's equivalent rent was up 6% in February 2024 compared to February 2023. The Zillow numbers can be found by Googling this phrase, average rental price in U.S. and market trends. There is a considerable lag in that calculation since rents typically roll over only on an annual basis. The lag is further increased by the government sampling rent prices at 6-month intervals and then using a rolling 6-month average. So the fictional expense is even made more fictional by the way they sample the prices. In many areas of the country, new rents for apartments have already started to decline, and annual percentage renewal increases are at much lower levels than reflected in the government's numbers. That's just a fact. So the idea is for me, to equalize interest income in 2024 and 2025 by shifting some income out of 2024 into 2025 and hopefully avoid a higher marginal rate in both years. Income shifting into the following year can be accomplished by purchasing treasury bills that mature in 2025, as I noted above, or CDs that mature in 2025 that pay interest at maturity. Treasury bills currently offer better yields, at least for compared to CDs offered by brokerages. For those living in states that tax CD interest, then buying the Treasury bill equivalent would increase the after-tax yield advantage for taxable account purchases. In addition to buying more 6-month Treasury bills starting in July of 2024, I will shift some money out of my Vanguard money market fund by buying Treasury bills that mature in 2025 and some corporate bonds whose first interest payment would occur would occur in 2025 compared to 2024. So those would be bonds that pay in July and January and so on.